I'm tired of always making all these compromises, constant times blinded by your fake romance, and all these hopeless antics make me thirst for loving. Pansy, would you take a freaking stand? I ain't here to be your bestie, you're moaning up, baby, to have everything right. I'm spending my time no attention with little game, baby, you're proving a fight. Yeah, no more making all these compromises. I'm not wasting no more time. You can't watch me work my grind. Cash and fornication.
Guys, if I continue to listen to the whole song, I'm sorry, it's so fun. Inanibamba sana.
Who is the artist?
Who is the artist?
Who is the artist?
Who is the artist?
Who is the
He's
artist?
the best artist, bro. Like, undiscovered, future Grammy winner, not even nominee. This guy produces, plays guitar, raps, sings. He's awesome. And he's sexy. It's me.
Oh, I saw that. Okay.
You didn't see that. Yeah. You didn't see that. But anyway, guys, welcome back to episode 22 of the Money and Youth Talk Show. I am one of your guests. My name is David Chai, and I am with my two co-hosts. On my left is Mr. Collins Rotich. Sema whoop whoop. Whoop whoop. On my right is Mr. Thomas Ongaro. Sema whip whip.
Whip whip.
Yes, you have a new one this week, guys.
Whip whip.
Yeah, we can't let them expect what we are doing every time.
Okay. Don't let them know your next movie. Yeah?
Exactly. Okay. Have you guys been?
Salama. 22 episodes.
22 episodes.
You know, if you do 2 more episodes, it can be a whole day for someone to watch 24 hours of our show.
Oh, because it's an hour.
Yeah, it's an hour show.
And it's like, you can tell the progress from episode 1 to episode 24.
But you should do that. You create like a link that has like a whole playlist going from episode 1 to episode 22, 23, 24.
Okay.
Someone sees the growth.
Hey, guys. Episode ya leo, it's very, 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 very interesting. I'm diving into it because in my part, which is the history, it's a lot. And I have PTSD for when I took half an episode to discuss the history of an instrument. And then I gave you guys like 10 minutes to do the rest of the show, which personally I did not like. I was very ashamed at myself. I did the whole whip on the back. So shame! You bring shame! So, the same we're going to dive into it a bit faster. I hope mneza ni allow nifanye hivyo.
Do your thing.
But before we begin, let me tell the guys who has allowed us to have this amazing episode. So, okay, kumbukeni what we usually do when I'm like marketing TDC. So,
yeah.
I'm not going to tell you what to do. I'm just going to see if you guys know. This episode was brought to you by TDC. If you're a fan of high quality denim clothes, a bespoke process that includes you in the production of your piece and investing in made in Kenya fashion, then TDC is the fashion house for you. Place your order today through the website at www.truedenimcollection.com and all our socials at True Denim Collection or TDC. We'll be able to have you sorted. Secondly, this episode is also brought to you by The Sharp Entrepreneur. Thank you. So, Sharp Entrepreneur is a practical learning resource developed by your mentor, our team, to guide young innovators through the fundamental steps of entrepreneurship. It's designed for people who are in high school or early stage of, I'd say, youth entrepreneurship. But it's also there for all guys. It's, as long as you're interested in entrepreneurship, it's the book for you. If you want it, it's 1,000 bob. It comes with the t-shirt, and you can get it through either one of your mentor socials or our website. Okay, I think that's a very good plugin. Cindy, can I get a whoop whoop?
Whoop whoop.
Thank you. I think I'm abusing the whoop whoops, but I can. In the position that I'm at, I can do it. What are you guys going to do about it? I just mute you. So, we've been doing the Unlocking Financial Freedom series for anyone who is joining us in this episode. For those of you who have been with us in this, I'd say, mini-series, we've been looking at the different financial instruments that young entrepreneurs can utilize to either invest, save, or just generally safeguard and grow their wealth. I'd like, and I want to keep mentioning this in every episode that we do, we are not finance specialists. Okay, maybe Kolo is,
Kolo.
but we aren't finance specialists. You get what I mean? So, we are all learning as we are doing all this. With every episode, we literally just do our research, and then we come and share what we know with you guys, on top of others that we have experience using the instruments. So, our topic for the day is unlocking financial freedom, rethinking life insurance for the young creative. I repeat, unlocking financial freedom, rethinking life insurance for the young creative. Insurance. Britain.
Britain.
So guys, as usual, allow me to dive into history. I'll start with global, I go to continental, and then I come to our sweet, sweet, beautiful country, Kenya. I will say that when I was doing history for this, it was the most interesting out of all of them. And you'll hear why. There's a lot of correlation between how just society does things for the betterment of society, and then how finance and the world of making money kind of comes into it later on. Mtasikilia hapa. So let's start with the global history. Mko ready? Are you guys comfortable?
Very
Are
comfortable.
you sure?
Yeah.
Sawa. The concept of life insurance, in its most fundamental form, is rooted in humanity's need for communal solidarity and financial protection against life's uncertainties. The modern commercial industry is a result of long, deliberate evolution, transitioning from ancient social contracts to a complex data-driven science. That is my opening statement. And we'll kind of understand this once you guys get to explain what it is now in a much more layman term. But kuna hiyo aspect hiyo ya uncertainty that is kind of the main cause of, or rather the main root of insurance. So the earliest precursors of life insurance were mutual aid societies designed to provide a financial safety net for a small, defined community. In ancient Rome, for instance, soldiers established burial clubs, which were called collegia, Collegia, where members would pay regular dues. These pooled funds were then used to cover religious rites and burial expenses of a comrade who died in battle, ensuring a respectable funeral without plunging their family into debt. So you guys watch 300 movies or zote, and you watch the action, but you don't watch the logistics after the
There's
action.
insurance.
the insurance.
Guy.
You don't watch the
That
insurance.
is crazy.
So this practice, exactly. This practice of collective risk sharing was also evident in ancient Egypt, where evidence from as far back as 4,500 years ago shows a soldier paying a stipend to a guild for burial services. Okay. So these early systems reveal a foundational difference from modern insurance, where their primary driver was not profit or a scientific assessment of risk, but a deep-seated social and cultural obligation. So now we know funerals were always expensive. And back in the day, it was still expensive. Burial, hizo kulipia, hizo vitu zozote. So that's kind of how it kind of started up. In these burial clubs, there was no sophisticated underwriting. Instead, a flat fee was paid by all members, regardless of individual health or age. So, the system operated on a principle of social cohesion and mutual assistance, not on the actuarial principles that would define the modern industry centuries later. The first stirrings of modern commercial life insurance emerged from the vibrant merchant culture of the 16th and 17th century London. Hello, our colonial parents have always wanaonekana kwa all our episodes. So the earliest known individual life insurance policy was created on June 18th, 1583, when a group of merchants underwrote a policy for an individual named William Gibbons, shout out to William, paying £30 in exchange for a payout of £400 if he were to die within a year. You guys hearing that? These guys were betting on whether William would die by the end of the year. So if you put £30, you had the possibility of getting a payout of £400. However, the formal industry took hold in the 1600s, coalescing around London's coffee houses such as Lloyd's Coffee House. This location became a hub for ship owners and merchants to underwrite and fund insurance policies for sea voyages, providing a marketplace for marine insurance. This also kind of goes back to when we're talking about, I don't know if it's MMF, what that the Dutch East India Company, they kind of had the same idea of either funding or insuring their voyages. So I'm noticing a lot of these instruments in kutoka hiyo common history are just
Trade.
exactly. So over time, this informal marketplace expanded to include other forms of risk, and by the 1750s, it had become a center for gambling on people's lives. This unregulated practice, where individuals without an insurable interest would bet on the deaths of prominent people, highlighted the need for a more structured and ethical approach. I'm not going to mention names, but it's like in Kenya, me and the homies seated, we're like, I think so-and-so might die within the end of the year. And then this guy is like, nah, he's too healthy. He's too young. That's what led to modern day insurance. So, this led to the passage of the Life Insurance Act of 1774 in the United Kingdom, which stipulated that a person must have a genuine insurable interest in another person's life to take out a policy on them, effectively putting an end.
They legalized gambling on people's lives.
Exactly, more or less, they legalized it. So,
So,
the most significant transformation of the industry, however, was the integration of scientific principles. While early companies like the Amicable Society for Perpetual Assurance Office, which was founded in 1706, were pioneering, they paid a lump sum to the beneficiaries of deceased members from a communal fund without a sophisticated method of calculating risk. So it was just... But the math haikuingia from when I started telling you this story. Now in the 1700s.
the man guys are afraid if you get life insurance, you can get killed by wife.
Your beneficiary can take you out.
Kumbe ilianza kitambo.
Wow. It's not
William, it's all William's fault.
William underwriting.
Yep. So,
Okay.
where am I? The breakthrough came in... Yeah, the breakthrough came with... Yes. The breakthrough came with the development of the first life table by Edmund Halley in 1693 and was later refined by mathematicians and actuaries like James Dodson and Edward Rowe Morse in the mid-1700s. So, the Morse Society for Equitable Assurances on Lives and Survivorship, founded in 1762, was the first mutual insurer to use age-based premiums based on mortality rates, thereby laying the mathematical and statistical foundation for modern, scientifically grounded insurance policies. This basically means when you guys look at packages offered by these different companies, a lot of them are grounded in data about the society you're providing those packages for. It's fairly new. Back in the day, it was just,
You want insurance?
you're gonna die. I'm sorry. You're gonna die soon. So, basi, let's insure you. That's what it was. So around 1762, this guy is the Morse Society for Equitable Assurances on Lives and Survivorship. They came up with that life table, essentially. So, moreover, in 1911, the first group life policy was introduced in the USA, facilitating the expansion of insurance to cover employees as a company benefit. So this is when insurance started now becoming a thing, like TDC having to pay insurance for the employees. You get what I mean?
Yeah.
And mind you, it started in the US. I've skipped. I couldn't put everything here. So I noticed a huge gap between the 1770s and 1911. Not a lot happened in between then. Market really ended up function how it was functioning. So today, the global life insurance market is valued at approximately $8.25 trillion in 2025. And it's projected to grow over $18.03 trillion by 2034, in case there's no COVID. If there is even COVID, it's even higher.
Better, yeah.
Exactly. Driven by a compound annual growth rate, or CAGR, of 9.10. This growth is fueled by increasing consumer awareness for the need for financial security and the expansion of the middle class in emerging economies, much like in Kenya. A significant driver for the modern market's evolution is technology. The industry is currently undergoing a radical digital transformation with modern cloud platforms, artificial intelligence, machine learning, and generative AI being leveraged to revolutionize operations. So that is the history, global to date side. If you look at the biggest insurance companies, places like the US, AI ni kind of the things that they're trying to invest into doing it to make more money. Think about it. So let's come into our beautiful continent of Africa, to which, just like every other instrument, we know who pioneered this thing.
South Africa.
South Africa, baby. So South Africa is by far the most established and dominant insurance market on the continent, accounting for a remarkable 70 to 79% of total premiums generated in Africa. Its penetration rate at 11.54% of GDP is not only the highest on the continent, but also well above the global average, which is 6.8%.
Damn.
I had put, I don't know if I have them here in my notes, but I had put Kenya's,
The adoption rate.
yeah, and it was
7%. It's under 2%.
yeah, it was low. It was very low. Like
It's under 2%. It was 1.3 like 2018. So it should be like 1.7.
yeah. In contrast, the rest of the continent demonstrates a very different reality. Excluding South Africa, the penetration rate for the remaining African markets was a mere 1.04, which is that was in 2012. And the average for the continent as a whole is around 3%. But in 2024, Kenya's penetration rate ilikuwa 2.25. So compare that. You're 11% ya South Africa, you're 22.25. I didn't put a lot of data hapa kwa the continental part because it kind of dives in a lot into why South Africa, the insurance market is different, not just with other African countries, but around the world. These numbers are very weird. I don't compare na the US, compare na Asian countries, compare na Middle Eastern countries. Why? Might have to do it for a future episode. Now, let me come into, I'm going into the 20th minute, so nataka go into nimalize sana national contextual history. Nchi yetu ya Kenya tunayoipenda. Si ndio?
Yes.
The formal insurance industry in Kenya began to take shape during the colonial era, of course, with British insurers establishing regional offices in the 1920s to serve the expatriate settler community and their investments. Following independence in 1963, the Kenyan government took steps to localize the industry, requiring foreign-based firms to be locally incorporated to ensure that a portion of the profits and capital would remain within the country. A significant milestone was the enactment of the Insurance Act Kenya, CAP 487, in 1984, and those are legal terms, which created the Department of Insurance to supervise the sector. This marked a crucial step towards establishing a domestic regulatory framework. Further reform in 2006 led to the separation of the Department of Insurance from the Ministry of National Treasury and the formation of a more independent Insurance Regulatory Authority. That's what I've done there. Yeah. Or the IRA. What's the one for the US? IRS.
No, but RS is revenue.
Oh,
RS is
okay.
KRA.
Okay. So, which now serves, the IRA serves as the sole authority for supervision and development of the industry. Kenya's insurance market is highly competitive, comprising of 58 licensed insurance companies and 5 reinsurers. However, this competition is concentrated at the top. The 5 largest long-term insurance providers collectively account for more than 63% of the total market share. Only 5. 5 wako na 63%.
Big fish, big five.
Exactly. Which indicates that while there are many players, high entry barriers and fierce competition favor a small number of dominant firms. Key players in the market include Jubilee Insurance, Britam,
Britam, guys.
Britam!
Insurance Group and Liberty Life Assurance, all of which are listed on the Nairobi Securities Exchange.
Britam alone.
Wait, there's no Old Mutual over there?
They're there, but
Top 5.
Sit top 5?
Top 5, bro.
Mutual last week, top 5.
Jubilee, Britam, CIC, Liberty,
Sanlam.
and I think called Mutual.
Sanlam wako na whole...
Double agent, umelipwa, si ndio?
Britam!
So yeah, these are the...
Sponsored on a Sanlam.
Loki.
Most of the ones I've mentioned, operations aren't just in Kenya. Some of them extend to TZ, Uganda. Try and remember that with most of these instruments, it kind of is also pegged to the economy of the country and how developed it is, and how diversified the population tries to put their money. So, I've actually done it in 20 minutes. As usual, I've said a lot of things, giving you guys a nice story. It was nice. Now you know we can bet on who will live the longest.
Hey,
among them.
hey. Wait.
And then
I don't want to bet to that.
whoever wins the bet makes the most money.
There's a movie like
Yes.
that. Eh?
Bet. Funny stuff.
After this we'll talk. We'll talk.
Okay.
So, Kolo, can you give us now, like, I'd say a more grounded definition, or rather a breakdown of what life insurance is?
Hii swali ilikuwa yangu kweli.
Yes.
Double it and pass it.
Double it.
Double it,
Pass to the next guy.
That's a very good question. I think Thomas
May
can you
have
tell
the
us?
You know, I think Chai knows how. Triple it.
I agree, triple it. Eh?
So, before I answer this question, I'd like Collins to give us
Wow.
Eh, one round, sawa. Well. What was the question?
more or less a layman breakdown of what life
insurance is. So insurance in general, I think, is a good basis point of starting. And I think you mentioned some key terms like the word risk. So insurance is just basically compensation for risk. I think that's the most layman term that you can put it at. Insurance is basically compensation for risk. Life insurance is compensation for life risks such as death or injury. You know, like you could get into an accident, maybe you can't work anymore, like losing your limbs, those kinds of issues. So primarily, life insurance is basically how do we compensate you for that risk. You know, so ideally it has two sides to it. There's the death benefit and then there's the living benefit. So in terms of definition, life insurance is a contract. That's the first thing you need to know. It's a contract between two people, two entities per se. You, the person that's taking the life insurance, the policy holder, and the company offering that insurance. So you agree, we sit down and say, okay, fine, me and Britam, let's agree. In the event of my death, I want a lump sum payment to be paid out to the beneficiary. So it could be your family. So you have a list of people. So it could be maybe your wife, your firstborn, secondborn, like that. Or for the more financially savvy people, the beneficiary can be an institution. So like a trust, you get. So like this money goes to your trust, and then now your trust is what caters to paying the beneficiaries. So it's just basically we agree, when I die, or if those are the death benefits. When I die, death benefit, or when I go through life-altering accident, so illness or disability per se, there's a certain payment that will be made to the beneficiaries. So it could be my family, or it could be an institution such as the trust fund. So that's basically it. It's a contract. Unanilipa when I pass.
So that our whoever is listening doesn't confuse it with any other type of insurance. There's a lot of similarities between life insurance and health insurance, and I'd really like for us to separate the two. What is the difference, if there is any?
It's two different products completely. Like there's no intersection, because health insurance is for medical bills.
Okay.
Life insurance is for payments for your life.
Okay.
So you get, so like if maybe your family depends on a certain income, that's what life insurance will cater to.
Okay.
Health insurance is purely for when I'm sick and I can't afford the medical bill, the insurance pays my bill.
Okay.
So they're both actually very important, and I think I'll be going to this later on, but since you brought it up, in this wealth journey, there's two sides to it. There's wealth creation. We've covered those ones through money market funds, stocks, bonds, SACCO to some degree. There's an element of creating wealth from your money. Then there's now wealth protection. How do you protect your wealth? So one way is through things like an emergency fund. Another way is through health insurance, because you're trying to, this is your asset. This is what makes you do. So health insurance caters for now your health, and then now life insurance caters for when you pass, how is this wealth you've been created gonna go into your estate planning? Like how is it gonna go into your family per se, because you know people die like this and then you have to raise like guys changa cash for medical bills every day. I'm sure you've been in many groups like those ones. So this insurance ensures that when you pass like this, there's lump sum cash available, usually within a week or a few days depending on the institution.
Okay, so Mr. Thomas,
Yes.
with everything I'm hearing, it feels like life insurance is for old people. It doesn't sound sexy, to be honest. We've talked about like stocks. Wow, you get Safaricom. Like,
Wow, energy.
This one,
It's like,
sexy. It feels like, yes, like,
slow.
oh my young. So, is it really relevant for young people?
Yeah.
And how so? How is it relevant?
I think it is very relevant. I want to tell you guys a story about some insurance company. Do you guys know the insurance company that insured the Titanic? The passengers who were in the Titanic?
I don't know, but Britam.
I mean, it depends with how the story goes.
Wait, it's not
I mean,
Britam.
they all died. I mean,
Okay, they all died. Yeah, true, they all died.
R.I.P.
RIP. And I did some. I was watching some podcast, and the guy was telling me about Prudential Insurance. Is the company Prudential Insurance is the company that insured those guys. Prudential Insurance was once in Kenya. And it was and then it came back. It left and then came back. So it got me thinking like, damn, a whole insurance back in those days insured guys, and apparently they paid out the claims of each and every individual of that. Yeah.
Interesting.
Yeah. So you see the importance of insurance.
Yeah.
That's just one.
I mean, you climb the Titanic, you're going to flex. Where you're now an ice pop. And then you're going to pay for your funeral rights
An
now.
ice pop is crazy.
That's wild.
That's why.
Didn't expect that.
Yeah. So there are a lot of benefits that come in insurance. One of them is that it has competitive returns of 8 to 12% per annum on your savings. There's free life insurance cover of 50,000 Kenya shillings. There's premium holidays and options of adjusting your contribution amounts in case of any financial difficulties. The minimum saving period is 5 years, but you can extend it to as long as you want. So with like things like you adjusting your contribution, your premiums, for us creatives, we have an opportunity to start early and at a lower cost, because insurance also check on age. They check on your age. The younger you are, the more you're capable of saving for longer and getting the benefit. The older you are, you'll have to pay more because your time is less. Yeah.
I guess this links with also going through the history, that life chart thing.
Yes. Another thing they always ask is if you're a smoker. Another thing insurance always asks is if you're a smoker.
Okay.
So that also, I think, those lifestyle that can come within a certain, so they have a way to manage it, Yeah.
I had to price it privately.
Yeah.
Actuaries.
Can you lie?
I don't think you're...
They do a medical test.
Yeah, and
Serious?
insurance, mind you, you're not supposed to lie. Because
It's
your life. For you to get your claim back, you have to be very truthful at every event that has occurred.
Okay.
Yeah.
Okay.
Yeah. So going on is you can also get a tax relief from insurance. Is it?
Interesting.
Yeah.
Abuk, tell me more.
So
about this.
what is a tax relief? Basically, it's an incentive that reduces the amount of tax that a person has to pay. So a person who has a life insurance policy receives a tax relief of 15% of the premium, subjected up to a maximum of cash 5,000 per month.
Okay.
Yeah. So or cash 60,000. No, it starts from 5,000 to 60,000.
Okay.
That's
Depending
a
on the
budget
package that
per
you-
year. Per year, not per
5K
month.
per month, 6K per year.
Oh, 6K, 5K per month. Oh, because it's now, it tallies up to 60K per year. Yeah. Tax rates are reviewed from time to time. Yeah, you can confirm the tax relief at any given time from the tax portal, the IRA.
So wait.
Yeah.
Whatever I'm paying isn't getting taxed. What is getting the relief?
Maybe I could help elaborate on that. So, So you're contributing a certain amount of cash per month. Let's say 5k. They give you a 15% tax relief on that. So remember that how insurance works is that you depending on how you do it, there are guys who put monthly premiums. So maybe you're putting 3k per month for maybe 5 years. The Thomas was saying it's like 5 years or like 10 years. So they tell you after 10 years we'll pay you 3 million. Or maybe after 5 years, we pay you 3 million. So remember, you've accumulated the 3k. It's this part of this 15 million that you're being paid out at once. When you receive an income, so how tax works is that the moment you generate, the moment you produce, that's why kuna producers. The moment you produce and generate an income, that income is taxable immediately. So if you get a tax relief, it means that the income that was going to be taxable reduces in value, meaning you're paying less taxes.
That cash that they'll give me.
On top of that, remember, see, it's 15% for all of those payments. Now remember what I was telling you, the beneficiary can also be a trust fund. So it's like putting all of your money at once into a trust fund, and there's tax advantages. So it increases your overall portfolio value.
Because even trusts, they get taxed differently.
Yes, they have tax benefits. So remember what I was telling you, kuna wealth creation and wealth protection. So rich people structure these things like that. They make sure that this cash, by the time it goes into their trust, they get as maximum benefit from it as possible. So the tax advantages in insurance policies come in handy as well.
Okay.
Just to add on also, besides the wealth protection part, is also an important. It's a benefit for us young individuals. Includes what we conclude in wealth protection is income protection, the money you're getting. So for families that rely on sole breadwinners, the sudden loss of income due to death, critical illness, or personal devastating injuries or accident, that's very important for them, because life insurance steps in to fill that gap by providing that act as a substitute for the lost paycheck. So within those, you're depending on one person, and you've lost them. It's shocking, because next month aujui kenye utapata, or you are relying on this person to either pay your school fees, or either feeding food or bills and stuff like that. So that's how insurance can come into income protection. So it secures your beneficiaries for a period of time. You're given that lump sum, and lump sum normally takes within as Kulu said, within 2 weeks. So after
it's very quick. So
it's
that
very
even,
quick.
If you have funeral expenses,
It's
within a week actually sometimes.
Another one is wealth protection. Besides income protection, there's also wealth protection. That's how insurance can cover you. Life insurance is an effective tool for preserving wealth and ensuring smooth generated transfers. One major advantage is that insurance payouts are, again, tax-free, allowing your beneficiaries to receive the full benefits without deductions. Additionally, life insurance bypasses the lengthy often time of waiting, and again, takes more like 1 week, 2 weeks to come out, since they cannot be contested in court. That's another thing, by the way, about insurance. So you see that when you die and you have insured your beneficiaries, and all of a sudden unasikia baby mama ametoka. You've heard those stories. You heard those stories of there's someone who's come and she said she has your child, but you're already gone. So now it brings up a whole steer of these people wanting something from your wealth. But since you've already insured yourself with the trustee, through a trustee or a will,
remember it's a contract.
Yeah.
So ushaonesha who's the beneficiaries. Yeah.
So it goes straight to them without that hustle and bustle for this. Another one is enhancing your estate planning. So estate planning is basically trustees and stuff like that.
Basically, how will your assets be distributed once you're dead?
So by naming a family trust fund as the beneficiary of your policy, you can inject much needed liquidity into the trust upon your death. Unlike other assets that may take time to liquidate or process, life insurance payouts are typically made within, 2 weeks. They ensure that your family immediate access of funds, preventing need to prematurely sell investments or properties during a period of emotional and financial stress. Incorporating life insurance into your estate plan provides stability and safety safeguards your family long-term financial well-being. Lastly is ensuring the continuity or in the family or in the business. So it provides financial stability during difficult times, allowing families to focus on healing.
Emotional part.
Yeah.
Rather than where we're gonna get cash to
Yeah.
deal with.
Yes. So one another without even added burden of financial stress. By covering essential expenses and future needs, life insurance ensures that your family can maintain their standard of living and preserve their unity even after the loss of a loved one. This peace of mind is invaluable during periods of emotional recovery. Yeah.
I think the whole time you were explaining how it helps young people, I was thinking the ones who benefit the most are mostly. There's so many young people who are the breadwinner of their families, firstborns. You get?
Yes.
And you find they're the ones who are working to pay school fees for their siblings.
Yes.
And I think for young entrepreneurs, those are the ones who this instrument might be the best for.
Yes.
Because the ones who are at most risk,
Yes.
if you think about it.
Yes.
For other creatives, maybe you are growing your wealth, or you're growing your income, and you want to start safeguarding it earlier.
Yeah.
But for that particular group, I was thinking of that old
That avatar.
exactly firstborn who the parents have passed away,
Yeah.
and they're the ones who are responsible for school fees, kila kitu for like 2 or 3 other siblings. There are so many of those people in the country.
There are.
So I think this instrument might be
Jeez.
kind of also tailored for them as young people.
Yeah. And
So-
Britam, see.
You see that
Britam.
smile?
Britam gives a life insurance coverage of what, 1,200 per month.
Yeah, they have affordable options.
Very affordable. Very affordable for young people, for creatives like us.
That is so affordable.
That is so affordable. And mind you, it's something that they'll pay out. You know, this is now, it's like a savings.
You can almost argue like Britam is the best insurance company out of these options.
Someone could argue
Someone could argue
Britam.
that Britam. Someone could
Britam.
argue that. Not us. Of course, us we aren't
Britam.
saying that.
No, say that.
No.
Can't say
Someone
that.
could, not us.
Britam.
Yeah.
Someone could sponsor us.
Britam, please.
Britam, please. Money, finance.
So I'm sure, much like other instruments, life insurance has different types of life insurance that are offered.
Yeah, definitely.
Can you like give us an overview of the types and which ones would you say are the right ones for young creative entrepreneurs like ourselves?
Thomas, could you tell us?
Double up.
Pass it out to the center.
Gentlemen behind the camera.
Join in. So, the types of insurance, especially in the Kenyan market, primarily there's 3 of them. The first one, which is the most okay, let me not start with the most common one. Let me start with the easiest barrier of entry. So there's 3 types. There's term life insurance, then there's endowment life insurance, and then there's whole life life insurance. I'll speak of them in that order. So the first one is the term life insurance. So the moment you hear the word term, it already...
It's like a fixed period of
Exactly.
time.
It hints at the duration. That's why first term, second term. It's a period of time. So term life insurance is where you're taking an insurance for a specific period of time. For example, taking an insurance for the next 10 years or the next 20 years. And what happens is that you only receive your benefit if you pass, remember what I was telling you, or you get injured or permanent disability per se, or a critical illness within that period. So, but if you don't get sick or die within that period, technically you lose that cash. You get. It's basically you're just insuring for a specific period. After that, you just write it off as a loss. So you don't get that payment.
Hypothetically, if I'm going to a dangerous part of Kenya, and the homies want to say they can bet on my me surviving or not.
Yes.
That's the best
insurance coverage.
Okay. We're getting somewhere. Okay.
Yeah, so typically, considering it's used for a specific period, it usually makes sense for let's say people who are in business, so that if maybe one of the partner dies off within the period they're doing the business, there's some benefit that if the family comes to claim, can be disposed or rather can be distributed to the family per se. So it's usually linked to a project base. Or for example, a mortgage. You've taken a mortgage for maybe 30 years or 10, 20 years, you insure that payment.
In case something happens before,
in case you can't work anymore, so the insurance insures that payment. So it's only for 10 years. If you don't get sick, well and good, but remember, insurance is all about compensation for risk. So when the risk occurs, you're compensated. If there's no risk, there's no compensation. You get. So even like think of that as insurance. If there's no risk, there's no compensation. So you're only compensated for risk. So term life insurance covers you for that specific term in period per se. Then the second one is called endowment. Endowment policy is the most popular one in Kenya. Primarily, it brings in those two objectives. Remember I was telling you there's a wealth creation objective, then there's a wealth protection objective, or in this case life cover. So it combines the saving side and the life side primarily. So what happens is that you agree with the company to contribute monthly premiums. So a premium is like a subscription fee. You pay it monthly, like the 1,200 per month Thomas was saying. So you pay this for a certain fixed period. Okay. The thing about the difference between whole life and endowment is also the time frame. Endowment has a period. Whole life is for your whole life until you die. So what happens is that it has two benefits primarily. If you manage to contribute monthly, remember that this is a contract. Remember the first thing we said, life insurance is a contract. So ukisema ndeka 1,200 per month, usipoeka umebreach
your contract.
That's why you hear guys who lose their money to insurance companies, because it is a legally binding contract.
Okay.
If you do not do the contract terms, it is a breach of contract. So endowment has that. Unasema 1,200 for the next 5 to 10 years, Then after that 10-year period, they give you a lump sum payment. You get. And it has that saving habit of lazima contribute also ama mazeneza lose stuff. So they give you like a grace period, maybe like 30 days. After that, you can get. So what happens is that if you don't pay, there's two outcomes. Either you lose it 100%. So whatever you've contributed, just write it off as your loss in your books. Or there's something known as surrender value. So kuna cash value, which is the cash value. Basically, portfolio value. Umeka 1 million kwa Britam insurance, hiyo ni 1 million iko hapo. And whatever bonuses or benefits or interest that's gained. Surrender value is what, ukidecide to pull out saizi, how much money will they give you? Ama if you don't pay and say, F this thing, how much money are you entitled to? So if you pull out mapema, like let's say if it's a 10-year endowment life policy, and you pull out year 2, pesa yote inaenda. Pull out year 7, maybe you'll get like of the cash value you've contributed, you'll get like a certain amount. Of course, kuna mahesabu zao and all of those risks you get. Or if you pull out maybe the last year, you get better returns. So primarily, the surrender value and the cash value is different, because cash value is what's your paper value. Surrender value is what you give up, or is what they give back to you once you give up. You get. So that's endowment policy. It's for a certain period, and you have the ability to cancel your plan and receive a surrender value. The third one is called whole life insurance. This one is a pure wealth protection asset. There's no wealth, as in there's no
payout at the end of it. It's just
there's not payout because you're dead.
Boost your beneficiaries.
Yes, no, because you're dead. So whole life, it means that you put this cash for your whole life, then now that lump sum payment upon maturity is paid to your family. Or if so, those are the death benefits. Life benefit, if you get injured, they pay you that payment per se. The difference is hapa hakuna kusarenda, bro. Hakuna surrender. And then after 10 years, you get a lump sum payment for endowment. The other difference is that endowment has something known as your surrender value. You can give up in between and you get your cash back. whole life. So it makes sense to use a whole life insurance because it's purely for protection. Remember, if you're an investor, your portfolio should have two sides. One side is to create money, one side is your soldiers for wealth, one side is to protect you if anything happens. So hakuna haja uze all of your shares. You need to have something like a emergency fund. That's your first buffer of security. Hakuna haja you lose all of your portfolio. Kuna another thing inaitwa sasa life insurance. When you die, all of that money can be pumped into your wealth creation asset, which can be even your trust, because your trust here, it's basically trustees managing your cash. So yeah, those are the three types. Term, specific period, and if you period ends and you haven't died, your money goes. Endowment, same thing kama term, iko na period, but when the period matures, unapata a lump sum payment. And then also you can exit. Kuna surrender values na cash values. And then whole life is basically your whole life is covered. And remember 15% tax relief. And then at the end of that period, that whole cash goes back into your beneficiaries or even your trust fund per se.
Which one would you recommend for, I'd say, like young creatives such as ourselves who have like your cash isn't as regular, it's project based? You get what I mean?
You see, the thing is, when the moment you get a contract called insurance, whatever umeandika utaweka monthly, it doesn't matter. You'd rather sell.
Nikwambia insurance broker yangu nikwambie bro, see
niko chini this month. Uko chini bro.
Ngoja ifike faster kushoot. Sasa
only sign contract.
Where's your life insurance now?
Yeah. So that's the first thing. I'd always recommend whole life insurance. Endowment is okay, but it's for wishy-washy people. So you see, when you're doing insurance, you need to think about the life cover aspect. Endowment iko na life cover na savings and investment to some degree. Because unapata, like for example, I don't know if it's Britam, I don't know if it's ICA Lion, the endowment plan, you get paid on 3 payments. You get paid maybe 20% after maybe like 3 years, another 20% after maybe another 3 years, and then after the final 10th year, you get paid the full 60%. So you enjoy the benefits while you're still alive, even though you're not injured or whatever. When I get so meaning that your value inapotea over time. You get
okay.
But
the cash doesn't necessarily grow in value while you're paying, Cindy.
It grows in value because insurance, like remember when Thomas was saying, they give you 8 to 12%, some even 14%.
It's kind of like an investment tool when you're using the endowment.
Yes. No, even for ingine pia, all of them give you percentage returns.
Okay.
But whole life cover, like for Britam, gives you 5%.
Okay.
You get. But so all of them give you, of course, growth on your value. But the most important thing is that life cover. Remember kuna wealth protection objective na wealth growth objective. Ukiangalia from a investment perspective, you're getting the 5% from Britam, but then pia kuna the 15% tax relief. I get. Same thing na endowment. Unapata 8%, but bado up to 5% month contribution kuna tax relief. You get. So whole life makes sense because of like it's you never have to think of estate planning. Okay, you have to. I mean, that's the whole point of finance, but it's like an assurity to your estate planning. You get. It's like you're already planning for how your beneficiaries or your descendants are gonna need your cash. So whole life makes sense. This other one, you'd get better returns from other products.
Okay.
You get, because also finance, you also need to look at those type of things.
Diversify.
So endowment, the reason why it's most preferred by Kenyans is because it's highly marketed, highly popularized, and also it's known as well. Na your benefit of short term. Unajua mtu ajiuliza,
commitment.
Think about it like this. Ukiingia life insurance, hii pesa honi.
Forever.
But with endowment you can.
Okay.
You get, with endowment you can get payments.
It's an exit strategy of sorts with endowment. That is in death.
Yeah, that is in death. And also you get benefits even though you are alive. Remember, what you're contributing na a premium, you need money in. What's coming out na a benefit. So kuna death benefit na kuna life benefit. Life benefit ni injury ama illness. But for endowment, kuna sometimes you get like a lump sum payment in between the period. So it also helps for things like education policy. Like if you have a kid, remember the term, I was telling you, the term policy una cater insurance or maybe like
6 months, 9 months.
No, for maybe like a business or maybe like those kinds of things. So even if you have a kid, you can use an endowment policy like education policy.
To pay for them.
Juu unaeka do unajua at some point you can be able to sort this stuff, certain things, even before you die per se.
Okay.
So that's a difference. But whole life makes sense. When you're getting life insurance, create whole life because of two things. 15% tax relief. Meaning that it's like you're saving 15%.
KRS amekuangalia. So mjamaa ni mjanja sana.
No, think about it like this. If you're gonna get 10 million as your payout, yeah? And say utaxiwe a certain amount.
Tumewekwa 30% bracket.
So let's say 10 million is taxable. Si ndio? Ukitoa 15% of 10 million how much?
The percentage is 75%.
Yeah, okay, so see 10 million, 10% is 1 million. Yeah. So add another 5%. So it's like 1.5 M.
Yeah.
Meaning that instead of your 10 million being taxable, it's only 8.5 M that's taxable.
Okay.
You effectively get a 1.5 mic.
If you
You inaingia bila hata ulizwi kitu. Hiyo ni yako. So instead of you being taxed your 10M unataxiwa 8.5 only. So that's what tax relief gives you.
Okay.
You get. So yeah, and then another benefit of whole life is you can borrow against your money.
Yeah.
So your money never shukas value.
Okay.
You get, for example, your Britam, they allow for you, let's say you save that 10M, you can borrow against it maybe a certain amount. Let's say you borrow 5M. 10M yako bado ni 10M and whatever return it was earning, you just need to pay back loan on that interest. And if you don't, they just deduct it from your
10M.
Okay.
You get, similar to how circles do it as well.
Okay.
Yeah, I think your story Dash be Safka, I think it was a circle, it was story a circle. But nonetheless, yeah, that's primarily the benefit. Whole life cover, you can borrow against it, kuna tax relief, and your do you get the benefits only for your future ukishapas.
Okay.
And if you die and you bought the loan, so just cut it. So whole life makes sense.
Yeah.
Okay.
Also, just to add one thing, riders, you can get riders from whole life benefits. Like
The riders are the life benefits.
The life benefits.
So the death benefits when you die, life benefit kuna accident rider, alafu kuna illness rider.
Depending on what you're experiencing.
Yeah.
Okay. We've said so many nice things about insurance, but as with all instruments, we have to scrutinize them and see why they are bad. I don't have a nice way of saying it. Why they are bad, why they are not good. So, Tome, can you give us like some downsides and misconceptions that are linked with life insurance?
Yeah.
Also,
Time. Okay, guys. So for this, we're going to take 1 hour. I'm joking. Take my time. I'm joking. So, for myths and misconceptions in insurance, the first one I'd say is if you put your life at risk, it's your beneficiaries that may speed up the unfortunate event, like what we're talking about. That's what a lot of people think. Utatumiwa hitman, but it's not necessarily.
But then that makes sense, by the not like for real.
But no, it's guys.
Sasa natafuta mapenzi ama nalipa life insurance. So what am I going to do?
Not okay.
But okay, it's in the interest of your beneficiaries that you stay longer because you contribute.
Is it?
Yeah. Because think of it.
Don't a Porsche.
Don't
buy a Porsche right now.
If they finish you right now and you haven't paid
You
fully,
don't have money for a Porsche yet. Umesave
they might go on a minus try to marry you.
Wanna buy Porsche on debt. Occupy to 10 more years.
Wow.
Just save for 10 more years.
Yeah, so but
that's first misconception.
Yeah, that one is huge. It's very huge.
It's even shown in movies.
Yes, yeah.
But it's
a lot of movies, even someone like wants to put themselves in a situation where they pass away so that their family can get the cash for.
Or himself choma kona. But not also even your death has to be like
justified.
Yeah.
Suicide's how your story.
You remember hivyo.
Hawataka kujua lakini usimuone. That's a bad joke.
Yeah, cut that out.
What? So next. Second one, it's useless because it only has death benefits.
Our sense of humor started showing.
We continue. Yeah. So no, it's not. Remember, Kolo said about living benefits. You can get both living and death benefits. In instances such as unfortunate events like critical illness that can cause disability, you can get insurance. Your coverage is helping you there. When you're still alive, you haven't yet death. So that death benefits is not necessarily, even in whole life insurance, there's that rider for. There's a life benefit. The third one is it's only for old people or adults who have dependents.
Yeah.
You see, that one, a lot of us think of it that way, but not necessarily. A young person can benefit from life insurance while whole life insurance basically is often associated with older individuals. It offers both living and death benefits, making it a valuable option for anyone regardless of age. When you add critical illness and personal accident riders to the policy, it becomes even more relevant, providing essential coverage for unexpected events that could affect anyone at any stage of life. The premiums are typically much lower. By securing coverage early, you lock in affordable rates, which means you'll pay much less or over the long term. On the other hand, it will if you wait until you're older, premiums will be higher and you'll end up paying much more.
To add on to that, as what Thomas was saying, when they calculate how much premium you have to pay per month, they factor in your age.
Yes.
So the older you are, you're more likely
Pay a higher
Pay more.
premium.
remember it's a risk. They're also calculating risk factors.
Young guys.
Young guys have lower risk factors, so you give them a lower premium. Older guys have higher risk factors, so give them a higher premium.
Okay.
On top of that, you see, you lock in that amount. You're 1,200 per month. You can lock it in and adjust in the future. But you've locked in 1,200. Someone 10 years older than you atapewa kama 2k, kama 3k, depending on those kind of factors. So that's one of the misconceptions. Even though it's for young guys, can benefit completely.
Yeah, very
And then
much.
even you're saving for a longer period. So you
yeah.
have the potential of even having a very, very lump sum payout for your family.
Yeah, eventually after those 10 years wakula mamita zako vizuri. So it's not necessarily for old people. Let's not think that insurance, okay, most people think it's coverage of health and stuff like that.
Genuinely, myself,
Yeah.
prior to us doing this topic, I thought insurance was insurance. Like,
Insurance is insurance. That's what
niseme wow, at least niko na sha insurance niko na sha
wow.
ina solve zote ina solve zote. I did not, it was so, for lack of better words, it was so unsexy as a financial instrument that I could care less. I'm not old. I don't feel like my bones do this when I'm walking. You
don't sit down and say
exactly.
Also, that could also be another factor that contributes to misconception.
Yeah.
Because of what you've just said. Because people think insurance is insurance.
yeah.
It's
yes.
only for insurance.
Oh yes.
They don't
Insurance
see the
things.
insurance
They don't-
things.
These other sides. Like,
And also because it's risk. People are
Yes.
like, people are very optimistic over their lives. No one's like, yo,
Yeah.
bro, I'm not gonna,
I'm not finna die anytime
I'm
soon.
not gonna die anytime, so I'm gonna live forever.
I'm gonna live for life.
gangster.
I'm a young, black and rich. Or a farming too.
OGs don't die.
OGs don't die.
Yeah. There's also life insurance is very expensive. I say no. That's
Depends with the
Britam is 1,200 per month. Britam.
Britam 1200.
50 times.
Britam.
sponsor
Please
and
tupatie ni
Sponsor
donuts,
was
eh.
a
Britam.
To pay financial freedom.
Please.
No, when we speak in public,
people
tunasema Britam saved
one.
our lives.
Yeah. we owe Britam.
Sure you.
Britam, we can assure you, we can insure us.
Yeah, so Britam gives you an affordable rate. So it's not
1200.
1200. It's not
That was for
expensive.
life cover.
Yeah, that's I think yes, that's the whole
The endowment policy.
that's endowment because it has a period of time. You can
That's
can-
endowment. That's endowment.
Then lastly is insurance companies always deny claims. Now I'll bring you guys back to that story of
Luigi Vendramini. Bang bang, bro. Hey, let me change. RIP to the insurance CEO who passed away. I take away my finger, I put them away. But yeah, deny, depose. Tusikat hiyo. Deny, depose, and the third one I'm forgetting. It's like there's three
3
These
Ds.
that the insurance companies use to kind of play people who are trying to claim their health insurance. So when this guy made the murder, he inscribed those 3
On the
onto
bullets.
the bullet. So
You
it
know, I
was like,
deposed something. Yeah, I remember that insurance.
many men wish death upon me, lakini niko na Britam insurance.
Freedom! Yeah. So, but that's again, I'll tell you that story for Prudential Insurance. They returned claims for those guys, if not all of the people in Titanic. So the thing is, their goal is to, an insurance company, their goal is to honor valid claims on the term and conditions outlined in the policy. Insurance policies are contracts of utmost good faith, meaning the insured must disclose all required information truthfully and accurately when applying for coverage. Remember what I told you? Usiende udanganye, ukidanganya
Utafanya claim yako ikivoid.
I know you have to be very honest and truth
It's
about
a
it.
contract.
Yeah.
You have to keep your terms of the contract. Say tunasema insurance alafu kesho unakaa crash by yourself.
By the thing about insurance for cars, which has just reminded me, I won't mention any names, but there's a famous YouTuber who has really played that game for insurance for cars.
I know what you're talking about.
Amegonga gari zake. Okay, I wouldn't say amegonga. Whatever happened. But he's leveled up from the first car he got to the car he's having now. There's
Insurance money. But I mean, it's like how lawyers play the law. A contract is just a legally binding contract. As long as you do loopholes within the that's why people hire good lawyers.
It's not illegal.
It's not illegal.
Might not be ethical,
yeah.
but it's not illegal.
Ethics and legality.
Mungu anaona. God is seeing you all.
So guys, in the interest of time, let's go into the last talking point. Na hapa ni wewe Kolo. Tutafunga nayo. I like life insurance now. Say hypothetically, I want to get a Britam. Hypothetically. I want to get like Britam to cover my life insurance.
Britam.
What
Britam stocks?
How can I get started? How can a young creative get started with more or less getting into this package? How can you, in the shortest time possible, and in the
it will even take a second. So like
one. Thank you guys for this.
It's fine.
Well done. So yeah, I was saying, all of these instruments we've discussed, all of them have the same entry point. Number one, you need to have your normal documents in order. ID, KRA PIN, bank account, full stop. Maybe proof of revenue, proof of income.
Depends on
the institutions. But just have your documents in order. Then go to Google andika Britam. Hypothetically whole space life space cover space. So Britam whole life insurance, whatever. When you go to the website, you'll see the terms. They'll tell you the benefits. They'll tell you something like as you earn a guaranteed amount like 5%, you can borrow against your policy. You are assured a certain amount from even like 3,000 a month. There's a certain lump sum payment that be paid to your family upon your decease. So then you fill in your details, and then a sales representative will get back to you.
Yeah,
it's that simple. And once you give them your details, you fill a form, you start contributing.
Okay,
you're done. Very simple,
guys. Me really enjoyed this episode. I've learned. I had a bit of prior knowledge with most of the last topics we've done, but genuinely, guys, I just thought insurance was insurance coming into this. That's why I had so much fun going through even the history and seeing how it went from informal. Hey, you guys, you noticing like chai na kohoa be weird. Unata survive at the end of the year. From that to what it is now, which is like, nenda talipia school fees watoto wangu nikipasa. You get? It's for whoever's watched, please do your research as well. We've only touched an hour's worth of hundreds of years of an industry yenye imekuwa exist na ina grow. So you doing your research can help you also learn and see some things that we might have not touched in this episode. I'm sure in the future we'll revisit it and see what we've learned. Maybe even bring a guest who is, I don't know, from Britam maybe.
Britam.
So, guys, Do you guys have a parting shot before we close? Start with Thomas. And then...
Yes, mine is just to mention about
Return life.
Britam, what Colin said. Britam.
I forgot. We haven't done.
So wealth protection. There's wealth creation and there's wealth protection. Advice for you to have a wealth protection portfolio. What is a wealth protection portfolio? This is where your coverages are. You put like one, emergency fund. What is the emergency fund for? Where it protects you from selling your long-term assets. Two, medical cover. You need a medical cover for your own health. You know, it assists you to tackle medical bills and stuff like that. When you go to hospital, it's just a smooth transaction. Lastly, whole life cover insurance. That one. In case of death, critical illness, personal disability, this covers your wealth and benefits your beneficiaries. That's all.
Amazing. Mr. Collins?
Me, the only parting shot I have, it's very similar to what Thomas was saying, but in this wealth journey, just study the rich and do what they do. Simona, rich people are lipangi taxes.
Collins ulipangi taxes. Guys.
Sina sorry ya Uhuru ati wana claim so they express with billions and billions and you're like just pay, like no, protect your money.
Loopholes.
Protect your money. Pay as little as possible to the government. Legally.
Thank you. Legally. Guys.
Legally. So if you want a way to save 15% on your payments,
Life insurance
in general, but your life insurance primarily. Kwanza whole life insurance. However, just remember, the biggest disclaimer you can have is like, I know so many people who got into like some of these products and because they didn't have the discipline to pay monthly, they ended up losing the money they put in. So imagine you've saved 5k a month for a year, that's 60k plus the returns kidogo, second year umefika 120k plus the returns. Unacha 150k ende tu hivyo kiufala. Because you don't have the discipline. So understand that this is a contract. It's not like a circle whereby you just top up as you need. Ama like a money market fund, you top up as you need. Ama like stocks whereby you just buy stocks as you need. Ama like tufanya money market bonds.
Like
ama
rent.
bonds.
It's like rent.
It's
You have
like
to
rent.
pay every month. You're obligated to pay as long as you are
Kwanza ulisign contract.
yeah.
Remember, I think that's another thing a lot of insurance firms don't tell you. It is a contract, bro. You can't mess up. So, yeah. Tax evasion. Is it evasion? Yeah. Avoidance is the wrong one.
Yeah, tax evasion.
Evasion.
Tax avoidance?
No.
Do not avoid it.
Yeah. So you can cheza a game for the rich right now. And also, of course, secure your family in the future. But primarily, if you're thinking like a company, like a wealth manager, this is a very, very important instrument to have.
Okay. That's very good. My parting shot is very simple. This month, I don't know if the viewers are gonna watch in 2038 when the robots have taken over and everything that we knew is no longer there. But in this month of 2025 August, you're meant to turn 5 years old, guys.
Whoop, whoop. Whoop, whoop.
This baby right here, this baby turned 5 years. We started on 12th of August 2020 on International Youth Day. And on the 12th of this August, they turned... Sorry, I did that. They turned 5 years old.
So that's a 5-year-old mentor.
This is a 5-year-old mentor.
Word.
Your mentor.
Yeah.
So,
Fire.
I guess I just want to say thank you to everyone who's been a part of the journey to this point. Before the episode started, the team was looking at edits done from the last episode, and it got very emotional because our producer behind the cameras alifanya kazi mzuri sana. If you're watching this episode, then you know what we're talking about. Perfect. It was beautiful to see because if you look at episode 1, you could see like our feet.
Slippers.
Yeah, was slippers granulated the 144 pixel video. You get what I mean because you're doing it live.
From sandals to microphones. We do have a microphone.
Look, now we're doing TVC.
Jackets.
For sure.
So my parting shot is just you start something and the original idea isn't what you see it as. You just need to keep going, man. I had a concept of us doing this, but now like coming and meeting the producer and him like telling me improve this, change this, remove this, it's it's a blessing, man. So thank you for being with us, guys. We don't take it for granted. Acha ni plug ya mwisho and then we can end the episode. So, you guys ready?
Yeah.
This episode was brought to you by True Denim Collection. If you're a fan of high quality denim clothes, a bespoke process that includes Collins. If you're a fan of high quality denim clothes, a bespoke process that includes you in the production of your piece and investing in made in Kenya fashion, then TDC is the fashion house for you. Place your order today and through our website at www.truedenimcollection.com. Also, this episode was brought to you by The Sharp Entrepreneur. Now, Collins, such a pata Collins actually. Umeshikilia sana. You're overused. I'm tired. This is a practical learning resource developed by your mentor to guide young innovators through the foundational steps of entrepreneurship. It's designed for young people, be it high school to early stage of entrepreneurs, and the workbook walks learners through key topics such as business opportunities, conducting market research, and so on. Finally, I want to say thank you to the studio where we're recording in. Shout out to Spiderweb Studios, second to none studios. You guys, kazi yenu ni safi sana. The producer ko behind the camera. Actually, come.
Producer! Producer!
Asante sana. That is our amazing producer, man. When you guys see the level of quality that we have in our output, see, I'm not editing those videos. These guys definitely are not editing that video.
Challenge accepted.
Oh no. But yes, our amazing studio is the
That
one
was
editing. Be sure to check out Second to None and Spiderweb Studios, and also just come and record your content here. They have a beautiful audio music recording studio over there. This is the podcast one.
Where is it located?
It's located in Lavalate. If you guys know Lavalate where it is, our gracious president lives just over there, so you feel safe. You feel very safe.
We're going to say hi.
Well, after this, we're gonna go. Tuende tu to knock. Tumuulize wagwan kazi yako.
What is the state of affairs?
Tumuulize
Yeah.
life insurance yake ni gani.
Yeah, by the way,
Uko na life
uko na life insurance
Unajua
kweli.
Britam?
Britam.
Okay, anatumia endowment.
Mambo ni matatu.
Kama
Britam.
He's using a term insurance policy for the term he's in presidency for.
Si one term, ni Britam.
term life.
No, it's that.
Oh,
Episode over.
oh, that's
Episode
fire.
over.
See one term?
Si one term,
Ni Britam.
Yeah, that's how the episode is ending. It's over.
With Britam, you can get 2 terms.